What's up, everybody? All right, so today we're going to talk about day trading terminology, and the term of the day is penny stocks and how to make a living trading penny stocks. Now, this is a question that a lot of traders ask me. When I first started trading, I gravitated towards penny stocks. And why would that be? It's because I didn't have a lot of money and I didn't think I could afford to buy stocks like Apple, Microsoft, Caterpillar. And I also figured that if I was trading stocks like that, most mutual funds, they only make 5, maybe 10% in a single year. So trading a stock like Apple, with a $5,000 account, 10% is 500 bucks. I'm not going to spend all my time to make $500 in a single year. I need to be making $500 a day. So that meant that I needed to focus on an area of the market that was a lot more volatile and that I thought had more potential. And so I thought penny stocks. You hear about people who have traded penny stocks and made hundreds of thousands of dollars. And so I thought maybe that was the place to go. Well, I didn't realize when I first got started how long it would take me before I would find any success as a trader. It took me 18 months of trial and error, and I lost over $30,000 during that time in my life. It was very frustrating. I kept losing and losing and losing. In fact, only 10% of the traders out there who try to trade the markets will be profitable. So, for me, at this point, I've now gotten over that learning curve. And so, what I'm going to talk about today are a couple of the different tiers of penny stocks and how you can figure which ones are higher risk and which ones are lower risk. So, why should you listen to me? Well, I'm a trader who, in the last 12 months, has made over $220,000 trading stocks. And a lot of those stocks were penny stocks. In fact, during the summer of 2016, I made $94,119 trading stocks, and many of them, again, were penny stocks. At the end of the summer, I did an interview, and that interview appeared on the Huffington Post. You can see I verified all of these trades with my broker statements to show you that the trades are real and the gains are real. And that article here on the Huffington Post, was about the 3 months that I spent trading the markets. This for me was, a great stretch. It was a really great hot streak, and really all of this is to say that I am someone who trades the market profitably, and I figured out a way to make a living trading stocks. And many of the stocks I trade are penny stocks. All right. So the most important thing for you to understand is how to differentiate the high risk penny stocks from the low risk penny stocks. And of course, all of this is relative. Day trading is riskier than long-term investments, but a lot of us come into the market knowing that there's more risk and looking for that risk to reward potential. I'm willing to risk money to make money, and this year I've done really well. All right, so what are penny stocks? Well, the SEC considers penny stocks to be any stock trading under $3 per share. And that's why a lot of the stocks I trade would be considered penny stocks because they're between $1.50 and $3. I personally focus on trading stocks between $1.50 and $10. So that means some of the stocks I trade technically are penny stocks, even though they're not penny stocks in the literal sense. In the literal sense, a penny stock, of course, would be a stock trading below $1. And these are generally some of the riskiest stocks to trade. In the last 12 months, the $220,000 I've made has come not from stocks trading at 10 cents, 20 cents, but from stocks trading between $1 and $10. And many of those would be considered penny stocks. All right, now we'll talk a little bit about the different exchanges that penny stocks trade on. Some of them trade on NYSE, Amex, and NASDAQ exchanges, but most of them don't. All right. The national exchanges require all stocks to trade over $1. Now, if a stock falls below $1 for a period of time, that's fine. They'll get a notice saying you got to get your stock back up above $1. And if they can, then they continue to trade on that exchange. If they can't, well, then they risk getting delisted. So let's take a look at some of the stocks that I've traded over the last few months. This is a stock, AVEO, that went from $1.80 up to $3.60 in one day. Versus the previous day's close, this went up over 100%. And this right here was a listed stock. This is on the national exchange. This was easy to trade. Lots of liquidity, millions of shares of volume, easy to buy, easy to sell. And there are traders who easily made tens of thousands of dollars trading the stock on this particular day. We trade the simple patterns. The first pullback right here, the second pullback right here. Here's another stock. Again, from $1.10 to $2 in one day, a 100% intraday move. So this is to say, to find big percentage gains, you don't need to look at penny stocks in the traditional sense of being under $1. You can get big percentage gains from stocks trading between $1 and $10. All right. And again, the entries here are very simple. The first pullback and the second pullback. Here's another stock from $4 up to $6.20, right off of our high-a-day scanners. We use these scanners to search the market for stocks that are moving up quickly. And whenever I see that, I look for an entry. This entry here was at 450 right after that little red candle. The first candle to make a new high was my entry, and we got the move all the way up towards 620. Again, an opportunity to make easily tens of thousands of dollars. And if you find a couple trades like this each week, you're going to do really, really well. Here's another stock from about 340 up to 433. Clean flat top breakout over $4, and then first pullback here from 418 up to 433. Simple patterns, and we teach these patterns and trade them every single day in the chat room. Here's another stock from $1.40 up to 308, a 100% intraday move. This, for me, represents an opportunity, right? The only question is whether or not you have the skill to capitalize on this type of opportunity when it presents itself. We see stocks make these kind of moves day in and day out. Here's a stock that went from $2 to $6.80 in one day. Look at that. I mean, that's an incredible opportunity. And these entries are not that hard. The first pullback and the second pullback, there's $4,390 in profit in one day. That right there is more than most Vermonters make in an entire month. So to be able to do that in one day, and really in just the period of about an hour, is pretty impressive. That's the potential of the market. That for me is the potential of trading small cap stocks. This is a penny stock in the definition, based on the SEC definition. It started below $3, and look at the move it made. This is a stock that I felt comfortable trading with large size. This is not a company that's pending bankruptcy or trading at 1 or 2 cents per share. Stocks that are trading at 1 or 2 cents per share, generally speaking, are some of the worst companies on the market. If they were good companies, they wouldn't be trading at such a low price. Here's another one, moved from $2 up to $9 in one day, right? That's pretty crazy. We asked some of the traders in our chat room whether or not they were profitable on this trade. My entry was at 250, and 86% said yes. You can see here, the first move up, entry at 250, pull back here, another entry over $4 for the move up into $9 per share. So these are trades where you could go in with 10,000, 20,000, 30,000 shares, and some of the most talented traders will easily make hundreds of thousands of dollars in these types of moves. And they only need to do that a couple times a year to be very, very successful. Here's another stock. This is a little more expensive, from $12 up to $19. All right, so this is to say that we see these opportunities all the time in the market, and the biggest thing I want to encourage you is to, to let go of that thought that to trade profitably, you need to trade literal penny stocks. You don't need to trade stocks priced at 1, 2, 3 cents per share in order to make money trading the markets. Now, penny stocks. This is an important thing. The minimum tick rule will affect penny stocks. So stocks that trade over $1 trade in 1 penny increments. And you can see here, this is a stock that'll trade, it has a bigger spread right now, but it can trade in increments as small as 1 penny. So it could be at 381 by 382 or something like that. Well, when stocks trade under $1, they trade in they've got 4 decimals. So they trade in 1/100th of a penny, which is pretty crazy. All right, so that means an 80-cent stock might look like this, 0.8199. This 26-cent stock is 26 by 2627. All right, so this further breaks down the penny stocks, and this is for the simple reason that if you had a penny stock trading in a 1 penny spread, the spread would become a very large percent, right? A stock trading 1 cent by 2 cent it can go up 100% just as soon as it goes up 1 tick. So this creates a little bit more market depth. It allows for more buyers to line up in between each penny. In fact, it allows 100 places for them to line up in between each penny. Now, I prefer, obviously, to trade stocks above $1. So the stocks that I'm trading, they all have your typical 1 cent spread. In 2001, the market underwent decimalization. And before that, stocks traded in fractions. So when we had decimalization, that really changed the market a lot because instead of having a minimum spread of 6.25 cents, the smallest spread went down to just 1 penny, right? So when you had spreads of a quarter, you had 25-cent spreads. You had spreads of an eighth, it was a 12.5-cent spread. You have spread of a 16th, it's a 6.25-cent spread. All right, so now the spreads are much tighter, and that means that buyers and sellers can get stacked up on both sides. And you can see here, it would actually take a lot for this to move all the way to 27 cents because of all the sellers that are lined up in the 100 places between 26 and 27. So for that reason, I actually don't feel that most of these penny stocks will move as quickly as stocks like this priced above a dollar. These will move faster. Look at this, can move from 381 to 386 almost instantly, right? It would take a very, very long time for this to move 5 cents. Now, there are a couple different exchanges where penny stocks will trade. Yes, some penny stocks are on NYSE and NASDAQ. These are stocks that have fallen below $1 per share. There is the requirement that all of the stocks on the NYSE and NASDAQ trade above $1 per share, but if the company's shares fall below $1 for a period of time and then come back up above it, nothing might happen. It might just be fine. But if the company stays below $1 for a long enough period of time, they can receive a delisting notice from the exchange. And what they're saying is that if your stock isn't above $1 by this date, your company is going to be pulled off the exchange. You're going to get delisted, and you're going to be moving to the OTC exchange. And that's really the opposite of growth. It's not a good thing for the company. They don't want to get delisted. So there are a couple different things they can do. They can try to perform well and have the stock get priced above $1. If that doesn't work, well, they can do a reverse split, a good old reverse split, and we see this all the time with small cap stocks. This is one that's been particularly ridiculous. GBSN, with all the reverse splits, it would actually be priced up here at $43,000 per share at the high of the spike. But you know what? And right now it's trading at 1 penny. It keeps dropping down, and they keep doing a reverse split. So how does that work? Well, if a stock is trading at 50 cents and they do a 10-to-1 reverse split, let's say you're holding 10,000 shares at 50 cents. They're going to take that 10,000 shares and they're going to turn it into 1,000 shares priced at $5. Okay, so all of a sudden your 10,000 shares turned into 1,000 and you're holding the stock now at $5. So in effect, nothing really happens. The price hasn't really changed. It's just changing the outstanding shares and adjusting the price. Right? Shareholders' value hasn't changed, but the price of the stock has changed to keep it above the $1 minimum and to keep it in compliance. Of course, if the stock then goes from $5 back down to a penny, they got to do a reverse split again. And they do that again and again and again. And that's why you end up seeing stock charts like this that just keep going lower and lower and lower and lower. All right. Now, eventually, this stock may not be able to do another reverse split, and they may get delisted. All right. And they will probably move to the OTC market. So once a stock has been delisted, it'll move to the OTC market. Although oftentimes stocks will list on the OTC market and never appear on national exchanges like NYSE or NASDAQ because they can't meet the requirements. All right, the requirements to be on either of those exchanges are really high. They have to be fully transparent. They have to show their earnings, the accounting, and all of that stuff. But with the OTC market, well, regulations are, there's still some regulations, but the requirements to get listed are a lot lower. Now, in recent years, the OTC market has changed a lot, especially in the quoting system. It's made the electronic quotes available on most stocks, so liquidity has improved. But in the past, liquidity and order execution times were very slow compared to NYSE or NASDAQ. So, the OTC exchanges may have a combination of electronically quoted exchanges, but also broker-dealer networks that aren't even listed. So as a result, the OTC markets are not as transparent for traders or investors. And that means the risk has increased. The risk is going up. All right. Now, there are several tiers of the OTC market, and those tiers help traders understand the type of stock they're trading. Now, these tiers separate the companies that are, not great to the ones that are like really bad when it comes to providing disclosures, providing earnings statements, and meeting the requirements to be listed. These are the three tiers of the OTC markets. You've got the OTC QX, which is the best market. Then you have the OTC QB, which is the venture market. That's the so-so. And then you've got the pink sheets, right? The OTC pink. And these are the rest of the stocks. They don't meet the OTC QX and they don't meet the OTC QB standards. And they're also subdivided into categories of kind of like crappiness. I mean, some of them are really, really bad. And this is where a lot of stocks become subject to manipulation. If someone wanted to manipulate the market, they would most likely use an OTC stock. All right, and we'll talk about that more in a little bit. Now, the important thing to understand is that the OTC QX, the best market, this is the sort of the highest quality of OTC stocks. They do have to meet pretty high financial standards. They have to follow best practices. They have to maintain compliance with securities laws and government agencies and stuff like that. And these are supposed to be some of the best stocks on the OTC market. Now, the venture market is the sort of development stage, and these are stocks that aren't able to qualify for the best market, but are still doing reporting, undergoing annual verification, and they're meeting some standards of transparency in the hope that they will move up to the best market. These companies also must meet a minimum price of 1 penny, right? And they can't be bankrupt. They can't be in bankruptcy. Now, the pink sheet stocks are, these are also subdivided into categories. And essentially, the important thing to know here is that any stock that is listed in the pink sheets is going to be a stock that doesn't have and doesn't offer a lot of transparency. And we really might not know a lot about the company, how much they make, their total net worth, how many employees they have, and stuff like that. Now, the fourth tier of the OTC market is the OTC gray market. And this is, I guess, even lower than the pink sheets and the pink markets. This is where stocks are not able to publicly quote the OTC securities. So they're not even being publicly quoted, and they're not going to be electronically traded. So for the most part, we wouldn't even see them, which is why I didn't include them on this in the images there. All right, so now traditional penny stocks, right? Traditional penny stocks would trade between a penny and 99 cents, right? That's a penny, right? So it's a penny stock. Well, they continue to trade in the increments of 1/100th of a penny, and as long as they continue to trade above 1 penny, they will be traditional penny stocks, and you may see them on NYSE and NASDAQ exchanges from time to time. So, if they haven't received a delisting notice yet. But some of those companies, they may be near facing bankruptcy. They are not in very good financial standings. Otherwise, their stock would not be priced at, a penny or 2 pennies or whatever it might be. So generally speaking, they are among some of the weakest stocks in the market, and they very rarely represent good investment opportunities. So that's not something that I would trade. Those are not the type of stocks that I've traded to make $220,000 in the last 12 months. Now, when you look at penny stocks, I always have my level 2 quoting just in 2 decimals because I don't trade the sub penny or the sub $1 stocks. But you can see here, these 2 stocks are listed on national exchanges. And so you can see NASDAQ as a market maker right here. And you can see, let's see, this one will have, well, it's got BATS, it's got ARCA, it's got EDGE. So, both of these, NASDAQ is here on the side, both of these are listed. Whereas these 2 stocks are on the OTC exchange. So you're not going to see NYSE or NASDAQ as market makers creating the market. You're going to see a different group of broker dealers and market makers providing the market for these stocks. And sometimes you'll recognize that one of these guys is almost completely controlling the price action. That's part of the manipulation that we can see in the OTC market, where one market maker, one broker is really controlling the price. Now, this is a sub-penny stock. So any stock trading below a penny, right? Now, this stock is trading between a tenth of a penny and 9/10 of a penny. So it's a sub-penny stock. It's just below a penny, but it's not 1/100th of a penny. It's a tenth of a penny. And you can see here the sub-penny stocks. You've got the two decimal points, the two zeros, and then now we're at 1/100th of a penny. All right, and you can see these stocks, for the most part, their charts are almost unreadable. Very, very little price action, very little volume. The only time these usually get volume is when a message board or something like that starts kind of promoting the stock or pumping them up. It's not something that I would ever trade. And then you've got the trip zero stocks. All right, these are the stocks that are trading in 1/100th of a penny. These stocks are priced between 0.0001, so the triple zero, and 0.0009 per share. So as you can imagine, these types of stocks are often used for manipulation because if a stock goes from 0.0001 up to 0.0002, it moved up 100%. So many of the quote unquote hot penny stock alerts are on sub penny stocks or trip zero stocks, and they primarily benefit the people who first bought the stock. Let's just say, for instance, someone buys 100 million shares of this stock at 0.001. That's $10,000. 100 million shares, but it's only $10,000. Well, if the stock goes up to 0.001, it's actually gone up enough for them to make $100,000. If they put in $100,000, it would go up enough for them to make $1 million. And that's why you see stock promotion and the pump and dumps in this price range, because it doesn't take a lot for these to move up significantly. Having said that, these rarely have the liquidity to buy 100 million shares. And who wants to do that, right? I certainly don't. And this is why traders who really are making a living in the market are never trading these stocks. They look like this, right? And look at how many shares you have on either side. This traded 300 million shares today, but this is what the price looked like all day long, right? There's nothing to trade here. You can't trade this. Now, I actually saw this stock because I saw it was on message boards. It was getting, promoted a little bit. And, people are saying, oh, it's going to go back up. It's like, give me a break. I mean, is it really going to go back up? This thing is at the bottom of the barrel. I guess it has nowhere to go but up, but this is not something I would ever put my money in. And the other place it could go is delisted, gone, bankrupt, and the money's gone. All right. So I have found in my years of trading that I can reduce my risk in the market by focusing on stocks listed on NYSE, on NASDAQ, Amex, real stocks, real companies. And those are stocks that they're going to face the requirements to put out earnings statements, to be very transparent. They're less likely to be used as vehicles for this type of manipulation that you see in the sub-zero and triple zero, sub-penny and triple zero penny stocks. Okay. Now, as you can see from some of these charts and also some of the charts of the stocks that I traded earlier, being a profitable trader, you don't have to trade traditional penny stocks. You can trade stocks priced between $1 and $10, and you can do really well. I had an account in 1 month that I grew from $1,000 to $8,653, and it wasn't trading penny stocks in the traditional sense. It was trading stocks between $1 and $10 per share. Right? That's a 760% gain, and I didn't have to worry about buying 1 million shares of a stock priced at 1 penny. I feel comfortable putting my money into these stocks. And the other thing that you have to realize is that for me, this is a strategy that's scalable because I know when I'm trading stocks that are liquid, I can buy and sell larger amounts of size. When you have a stock, let's say like AKOA or AKAO, this is a stock that in the last few weeks has gone from $5 up to $16. It's a 300% move, and it's on millions and millions of shares of volume. So this is a very, very liquid stock. Now, for me, I may only buy 5,000 or 10,000 shares, but other traders who are maybe have bigger accounts than me, they might feel comfortable taking 50,000 or 100,000 shares. And on those types of moves, they could make $400,000 or $500,000. And they're doing it in a 100% legal way, a 100% ethical way, trading a stock that's simply strong because it has a catalyst. And you could never do that trading penny stocks. So if you learn how to trade the stocks between $1 and $10, and you can be profitable, if you can make $20 a day and then scale that up to 50 and then 100 and then 200, you're on the same path as me. That's what I did. I started with 100 a day, built it up to 200. Next thing I know, it was 400, 500, and now on my best days, I make maybe even $10,000 to the point where I made $94,000 over the course of 3 months trading stocks like this. A stock that a couple of weeks ago was priced at $1.91. Big news, surged up to $5, pulled back a little bit, squeezed up to $6. That's like a 600% gain. And we see this happen all the time, right? So you can make a living trading penny stocks, but it doesn't have to be the sub penny, the trip zero stuff. You don't have to mess around with that stuff. I don't know a single profitable trader who trades those types of stocks. All right. So if you're thinking about trading penny stocks, make sure you step back a little bit and you think about the big picture. The big picture is that if you want to build a career that you can potentially be doing for the rest of your life, and I say this, we've got a student who joined our room just this week who's 81 years old. He's been trading. This is his career. He's been doing this his whole life. You can do this for the next 30, 40, 50 years of your life. So set the foundation that's scalable. And for me, that's based on trading stocks between $3 and $10. And then if I want to trade stocks between $10 and $30, now I've got the account size to do it, and the same principles apply. So I can trade a stock like Tesla, or I can trade Nvidia. This is a higher price stock, but you can see this was a pretty strong one today, and it had a lot of opportunities. So once you've built up your skill, now you build up your account and you can scale the strategy to any price range. And then next thing you know, you are buying Apple, IBM, and Microsoft, and you're trading the strongest stocks on the market. All right, guys, so I hope this has helped you understand penny stocks. If you have any questions, I'd love to have you comment below. I'll make sure to come back and answer them as soon as I see them. All right, thanks, guys.
Let's be honest. If you made it this far, you must have really enjoyed that video. So what's stopping you? Subscribe right here and get email alerts anytime I upload new content. Until then, happy surfing